What is up, everybody? Good afternoon. We are here to discuss what everyone has been waiting for now an entire week after seeing those inflation numbers. What was Jerome Powell and the Fed going to do? The number has come out. It is 75 basis points. So, lot to unpack here. This was what was heavily projected. So, hey, they got one right. However, Jerome Powell's got some explaining to do because as we talked about this morning on Coffee and Crypto Live, at least if he was sticking to his word from a month ago, he wasn't planning on 75 basis points just yet. But clearly inflation was so bad he had to reconsider it. I am very excited to get to watch him talk here in about 20 minutes and explain himself as to why he ended up making this hawkish move to 75 points. Again, we talked about it on our show this morning. It really was the move he should have done. So for that, I do applaud you, Jerome Powell. However, this does, in fact, make you go back on something you said a month ago. I want to hear that. That is probably what I'm most excited to hear. I really hope someone in the audience asks him that question about what he said 1 month ago. But I'm joined by T-Shroom and Smay as well. How are you guys doing this afternoon? You guys have a good lunch?
Yeah.
Yeah.
I had sandwiches.
Yeah, I had a nice recession sandwich.
Yeah.
It's very delicious.
We made a lot of very economical choices. So
Yeah. And one of which it's not coffee and crypto, right? We are on a different show. It's a Fed special.
It is.
And I'm having a little bit of hydration fluid here.
Wow.
A little bit of water.
That's water in the coffee mug, huh?
Yeah. And I don't know why I didn't think of this before. It's just so good. So hydrating, and there you have it.
Well, there we go.
It's going to be good.
Well, let's go ahead and jump into this. Let's talk about it. 75 basis points. T-Shroom, what was your reaction when you saw that number? Were you surprised? Were you expecting it? What are your overall feelings right now?
Well, why don't you go ahead and go to my screen so we can actually see, an actual print of this. So this is dailyfx.com. They print it not by the basis point, but what the current interest rate is. So now the current interest rate is this. The actual, what it was forecast, which is interesting, is 1.5, and that just goes to show you that this currency trading website, they had their forecast at 1.5.
They had that 50 basis points,
right? And that's I think what the official forecast was from the economic world, but that's not days in advance, as we discussed at length on the show. That's not what the actual CME was predicting. But anyway, so what did I think? Well, I thought I'm not that surprised. But this is very interesting. This was not a big PR stunt to try and give people a little bit of a shallow end entry to this much bigger rate hike than was anticipated. This wasn't PR. This was real. This was the real deal. And there's so much to dig in here on. Again, I'm extremely interested to hear what Jerome Powell has to say for himself and the reasoning, behind this rate hike, triple rate hike. It's going to be really, really interesting. I'm looking to see how he responds to the questions that are asked to him, because he's going to have a really well stated, summary of the argument here. But the questions are the real curveball, and they're really interesting. So, Tim, what did you think when you saw it? I mean, you were predicting the 50 basis point hike, and I don't know. I mean, predicting is probably too strong of a word.
That would be a strong word. I was sitting on the fence between the two. And again, the rationale for 75 makes a lot of sense. However, it was one of those things, especially with that news article I read this morning, a former staffer believed that 50 was still going to be there. And that was somebody who was on the inside, heard the conversation. In fact, that's what I'm really interested to hear even in this press conference is how close were we to a 50 basis points? Like, did we just barely make the cut and they were just like, we got to go ahead and make this jump to 75? Or was it they've been talking about 75 and thinking 75 this whole week, just like the rest of the CME futures market? I'm interested to see what their explanation is, because here is, the real thing. Go to my chart here real quick here, Smay. I'm on the minute chart. Don't usually go on the minute chart. Just that's how I want to see it right now. I'm actually not looking at Cardano. Those of you who have been watching, we actually, in the matter of 10 minutes, Cardano, before the announcement, jumped 6%. And it made a little splash there, but of course it comes back down. We touched 50 cents all the way up here on Cardano. Then we came back down. We've touched as low as 46.2, 46.3, somewhere in that region. Let's go to Bitcoin, though, where Bitcoin is just as volatile. But again, a little bit further to the downside. This yellow line right here is that 20,000. We are not there yet. We're not touching. We didn't touch it here the other yesterday either, but we are flirting right there with that $20,000 line. We do have a lot of volume here on the minute chart. I'm not going to read masses into that, but a lot of volume means as this price dip, a lot of bulls are sitting there ready to buy. This is something I'm going to watch throughout this show because even though the price originally responded bearish to this news, there's a lot that's going to happen based off of what Jerome Powell says himself. It's not just about the number. It's also about what could we expect in the future. What is the Fed's overall sentiment right now about inflation? Clearly, they're concerned because they went ahead and jumped to 75 basis points, despite the fact that Jerome Powell said they wouldn't do that. However, will he try to save face and say, no, we still have it under control, everything's going to be okay? Because if that's his response, I do believe 75 basis points was worked into the price, and now we're waiting to see his remarks. We know the number is hawkish, but will his remarks be leaving Americans with a little bit of a dovish feeling of, hey, I know this sucks, but everything's going to be okay. I am happy, though, that he did this. And I talked about it a little bit on the show this morning. You're kind of sitting, rock in a hard place. This is really sad. I do think that this hike, and we're probably going to see 0.75 again next month, unless we see some ridiculous turnaround. Don't think that's going to happen. More than likely, we will see jobs be lost. I think that there are people out there that will end up losing their jobs. The economy is going to struggle with this one. There will be strength coming back to the U.S. dollar, but at the same time, companies themselves will be struggling. But the problem was if we had stayed dovish with a 50 basis point or gone ridiculously dovish and backpedaled to 25 basis point, which I don't think anyone really thought was there, but it was possible, then we would have saved jobs for now and then lost them later on. I do think I'm in the camp of saying, let's go ahead and get the max paying with done now. I would have preferred us if we had done it a month ago, but I'm glad that he bit the bullet, went ahead and said, all right, we're going 75 basis points. It just, continues to lead me in a camp of, well, we can't really trust what he says. So I still want to hear his responses, but who knows? I want to hear what he says to the questions, but I also know based off of listening to last month, can we really trust anything he says that much? The good news is the rest of America will. So, or not the rest, but there's a lot of people out there that will trust them. As we're speaking right now, Bitcoin is climbing. So there's this season. We did drop, we came down, but now we're going back up. The volatility is still here. I still think the market really hasn't decided what it wants to do. Does it want to hold 20 and potentially just move sideways? Does it want to use 20 as a strong level of support? We're in a good zone right here. Are we going to go ahead and rally up? Are we going to say, nope, there's super hawkish news coming from Powell and the rest of the Fed, so therefore let's go ahead and break through that level of support at 20,000 and head down towards 19, 18. Who knows how low we could go. We got to wait here for about 13 minutes before we start to get answers to that. But as it stands right now, there's hope. There still is hope that the market could see a short little relief rally. But we will find out. Smay, what are your thoughts? I'm going to hear from you. I know you didn't get to talk that much on Coffee and Crypto this morning, but what are your overall thoughts about the market right now in this Fed announcement?
I mean, I think this is definitely was to be expected. I think it just choreographs that now the Fed is trying to take a lot more aggressive of a stance against the inflation. I think they were maybe taken aback by the inflation or the CPI data reading 8.6%. Mm-hmm. So I think really this is why a lot of people pivoted from 50 to believing that it was going to be 75. And I think this played out exactly as people expected. And I think this also does kind of, in a way, debunk what I thought was going to happen. Because I'll be honest with you, I thought they were not going to do what everyone else was expecting. And in that means I don't think we're probably at this point I don't necessarily believe we're going to go below 20. I think this potentially was because it was foreseen 75. I think people already expected it. I think people made their trades based off of it. I think it was probably already baked in. And so I think that at this point it's just like we'll wait and see after the press conference based on what he says about it. How are people going to react to that?
Yeah, I think, based off of the chart, I went out to the hourly chart just so I can see more data. As we crash, back here last week is when we got that news. It then went down into a dip. I would say right now, based on what price is doing, I would say it's still sitting on the fence on if the price is baked in. There's arguments for, there's arguments against. The fact that it didn't just let out and start dropping below 20,000 means that there's a chance the price is baked in. I think at this point, like I just said here a little bit ago, I think people are waiting to hear the actual remarks from Jerome Powell. Because again, if you guys paid attention last month, that's where all the meat actually happened. During the press conference, we actually started to see the price of Bitcoin rise. It was kind of the same thing last month. We had some volatility, moved sideways mostly, and then I remember as you listen to him respond to that question, hey, what will it take to raise it to 79 basis points? And he said, I'm going to need to see months of data before we even consider that. you could watch as he made that statement, the price began to rise. So are we going to see a similar situation that in all reality, we shouldn't trust because he's shown that he's not going to stick to his word, but it's still going to give the average retail investor and institutions hope to think, all right, at least for the next month, I can make some money and we're going to see the price climb. Of course, the next day when the Bank of England came out and gave their report, and they gave a more dovish number of only hiking by 25 basis points, but then their remarks, their press conference was FUD. I mean, it was fear, uncertainty, doubt. We don't know what's happening. We're in trouble. And of course, the market began a big crash. You guys remember what I'm talking about? I'm going to go back to the 4-hourly chart and show you that one because let's actually go to the daily chart.
Go to that daily chart.
Let's go to the daily chart right here. Do you remember? Let's see. The date of that was, I think it's right here. May 5th. This right here. This 4-hour. This daily chart right here. This was the day. This was the day that the Fed announced we had a green candle. This was the day the Bank of England announced, and we had a bearish engulfing candle that sent us down. Of course, that had that wick come down to 25.3. That's what started this whole side of movement, and now we're down at 20,000. Do you know, T. Shroom, does the Bank of England announce their response tomorrow as well, or is that later this week?
It's a good question. If you go to my screen, you will see that the Bank of England does indeed have an announcement tomorrow on the 16th.
Wow, so that's going to be really interesting to see the combo.
We'll have to decide whether or not we're going to cover that. Probably not. Because
Well,
last time it was
I don't
in
think
the
we're going to do
morning.
live on that. We'll
Yeah, it
definitely
was in
talk
the
about it on
morning.
Friday. Friday, that will be, you guys will see it happen. And who knows, maybe we'll
Friday,
shoot
it happens tomorrow morning.
Yeah.
it
our
comes out in
time.
the morning?
Yeah, their
Should be-
decision
we've
happens
covered on
tomorrow.
the stream
Good catch,
tomorrow.
good catch.
Yeah,
Yeah.
but another thing I wanted to show you guys, if you come to my screen, so this is the Wall Street Journal's front page right now, and I didn't realize this, but this involves your boy T. Shroom actually directly. Fed lifts rates by 0.75, largest increase since, and this is where I come in, 1994. It's actually the year of my birth, which is kind of interesting. So the last time that they were, and if you look at this chart, you see just how much more precipitous this increase is than in the past. But the last time that someone in the main seat of the Fed was thinking this aggressively was when I was coming into the world. So, it's pretty interesting. Also, another thing to note is what I've got highlighted here. Didn't mean to click on it, but what I've got highlighted here, ECB looks to tackle borrowing costs in weaker economy. This is what I was talking about earlier, and I pulled up a Reuters article on it. Basically, this is ECB's crisis weapon pledge is vague and late, meaning there's countries in the EU that are hurting much worse than companies like Germany and France. And basically, they don't have the same latitude to increase their rates at the same level, even though they've said that they're going to increase their rates. I think it was 25 basis points, the ECB, in July. But they're having to create a new tool. So the European Central Bank has seen the light. The ECB is acknowledging at last that it must address ever-hiring borrowing costs for some Eurozone economies. Its governmental council says it will accelerate the design of a new monetary policy tool to tackle the soaring yields of weaker states. So you can leave that screen, but it's having to put more funds towards an existing tool that it has to help its weaker states. And here in the U.S., we have the advantage of only having one sovereign country. So it really helps, and there's only one rate. But that's not a luxury that the EU enjoys. So it's a little bit more complicated over there, and that's why we said the U.S. is in a pickle, but the EU is in a bigger pickle, right? So that's really interesting. But the bigger takeaway there is that 1994, when your boy T. Shroom came into the world, was the last time that they wrote.
1994.
That was the year I came
of our
into the world.
T-Shroom.
Really?
Yeah.
Well, there you go.
I think we go back. I keep forgetting that you and I are the same age. I always act like I'm, I feel like sometimes I'm acting like you're like 24 or 25 or 26, and we're both. You're 28 now, right?
I'm just so immature, though. I think usually
that's not
probably why
okay.
you think I'm so young.
All right. Go ahead and take it that way. Let's go ahead and let's go to some chat here and respond. We got a couple minutes, 6 minutes before we're actually going to go live to the feed. But Michael W. said, I'd rather him do what's necessary rather than keep his word. And Michael, you're absolutely right. In the short term, I'd much rather him do what is necessary. At the same time, you could say, Tim, you're asking for a lot there by saying I would really like for the people in power like that and the people of the government to tell us the truth and be honest people. But you're right. I mean, as I'm saying it, I'm saying, yeah, I'm asking for a lot there, but I'd at least like for them to, semi get there. And you're right. I think I am sitting in a camp of saying, if you ask me, Tim, which would you prefer, Jerome Powell be a liar or the basis point stay at 50? I'd rather him be a liar. That's the truth. So I'm actually very happy with this. Now, I want to hear what his response is, but Michael, you're absolutely right. We're asking for a lot to ask for Jerome to be honest there. There's another one. I've seen a couple of different people talk about how they don't believe this is the bottom. And guess what? No matter what happens, I'm in the same camp. I don't think this is the bottom. I've talked about this before. You can go to my screen. There's May. I'm going to go out to my 4-hourly chart. I've said there's a couple things we could break down and we could go lower right now. That's absolutely a possibility. I think a very real possibility. I'm going to go out a little farther to the daily chart. Another possibility would be a relief rally where we actually end up bouncing back up into the 30s, maybe low, mid 30s. We hover for a while, maybe come down, and then come back down later, either to the same levels or even lower. And don't pay attention to the time frame. I know that says September, but I'm not trying to predict an exact time. I'm trying to predict a movement here that I would not be surprised to watch us actually rebound right here, have enough support, and then set up another level of bullish RSI divergence. We technically have some right now. It's not the prettiest. I don't think that's going to... I think we're going to reset it there. So where potentially our RSI bottoms here, we come back up. And I'll draw it right for you guys. But while the price might go lower, the RSI will not go as low, and we'll reset our bullish RSI divergence, and then we'll maybe see this fall a resume in the bull run or a new bull run, depending on what your camp is. I still today was seeing multiple people who are holding off that this is still a bull rally, that we have not entered a bear market. That's not the camp that we're in anymore. I do believe being down over 60%. I don't think you have to say 85%. I don't think we have to go to 85% to confirm this was a bear market. I think being down as far as we are, it's pretty safe to say this was a bear market for Bitcoin. The question is, when do we bottom? When do we go? Whether we bottom at 20, whether we bottom at 18, 19, I think time-wise we are not at the bottom. I do think we'll be back at least at these levels, if not lower, here in the next couple of months at some point. G-Stream, do you have any thoughts about that?
No, not really. I'm just reading the chats, talking about ADA pumping or not.
Yeah, ADA is sitting there hovering at 47. I put a tweet out actually. If you guys were watching the charts, it was weird. Cardano and Bitcoin have been constantly going back and forth. You don't have to go to my screen for this, May. They've been constantly going back and forth as to which one is outperforming the other. So, for example, you'll see times where they're both rallying, but Cardano's rallying faster, that they're both dipping, but Cardano's dipping faster. There's been other times where Bitcoin rallies more, other times Bitcoin drops more. But today I actually saw there's a period of time where Bitcoin and Cardano were actually divergent. They were going in opposite directions. Bitcoin was dropping, Cardano was rising, and that was really weird to watch. It actually, for on 2 hours of candles, if you go and look at all the candles in there, they were doing the exact opposites. And then I would watch as Cardano dropped, Bitcoin would rally. So that begs a question that we're not going to have the answer for in this show. Is something spicy happening over Cardano that it's actually starting to peel away from the rest of the market, specifically Bitcoin, to do its own thing? Now, as we speak about it, it just climbed over 48 cents right now. Again, there's some volatility in the market. Let's wait for the responses of Jerome Powell. But there's some good hope here that we might not have to go below 20,000 on Bitcoin. We might not have to go below 1,000 on Ethereum. We might not have to go below 40 cents on Cardano. We might see, at least in the short term, a relief rally due to the fact that the more recent drop in this last week was due to priced in fear from that high inflation. But yeah, we got 2 minutes here. We're about to go live. Is there anything else in chat that you guys are seeing that we can respond to here in the next 2 minutes?
Not really.
We got 1,800 people watching, 275 likes. If you guys have loved this so far, smash that like button. If you're new, thank you so much for choosing us to watch this with. Go ahead and hit that subscribe button where you can tune in every single day. We have a morning show called Coffee and Crypto Live. We analyze the markets. We look at the technicals, the technical analysis. We analyze the biggest pieces of information coming in and day out to help you stay up to date on everything you need to know about crypto to make wise investment opportunities come to life for you. We're really big on you being in control of yourself. Don't listen to other people. Learn constantly. Continue to invest in your education, but get yourself to a position where you and you alone control your financial future. We call that financial sovereignty, where you have control over your money, not your money having control over you. Again, if you're new and that's something you love, smash the like, hit subscribe, and come and be a part of our community. It's a fast-growing community, one of the best communities I've ever seen in all of YouTube. You don't want to miss out. Come join and be a part of what we're doing here. But I think we're literally in a countdown at this point.
30 seconds.
Less than a minute. So, May, anything you want to say to the people?
Yeah. I want you to hit. Oh my gosh,
that car. There's a car outside for like last week and a half.
If you have a car that goes off in the middle of a workday
and you're parking outside our building,
can you guys please get your car fixed or Uber to work? Thank you.
All right, 5 seconds.
Oh, there it is.
That's nice intro music.
Yeah, they.
I was going to say. Here he comes.
We were jamming to the Fed beats earlier. They had a long.
Wow, what happened to our intro music? They got rid of it.
But yeah, they had some nice beats earlier, just kind of in the lead up, kind of in the waiting room of the Fed live stream.
You wouldn't think the U.S. government would have good beats, but
Yeah. Well, while we're waiting, is it? Oh,
No,
yeah.
he's there. He is.
We're live. Is he there?
Oh,
yeah,
there he is.
Hey. There's some question in the chat. We'll respond to you a little bit later.
He didn't bring his printer.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can
How about that?
of
First
what role
question.
you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this.
Bitcoin.
So we decided we needed to go ahead.
Bitcoin
And
up
so we
to
did.
Bitcoin's
21.
And that's really how we made
21,500.
the decision.
Yeah.
Gina?
That was a good skirt of that question.
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Good question.
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline.
Dang.
We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July
That
meeting.
right there is going to be bullish.
You know,
the fact that
in
he's
that
already moving
range,
direction.
in that more normal range, and that's a desirable place to be because you begin to have more optionality there about
Bad
the speed
answer,
with
but
which you
it's
would
gonna be
proceed going
bullish short term.
forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And so
Bitcoin
much
is over
data and so much can
22,000.
happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much.
I think
and
he
if
was
they're not,
told
then we
before
either do
this,
that much or possibly even
when
more.
it
But in any
doubt,
case,
just
it will be
talk
very
about the
data
word
dependent.
data.
Then you're
Yeah.
looking at next year, and what you're seeing
Just
is
look at the
people
data.
see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve Leishman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now
Interesting.
that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done and breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized
exactly what I was talking
before?
about right there.
So if you look at We look at a broad range of inflation expectations.
That's the question right there.
So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned,
So
one
they
of the
weren't taking
factors
it
in our
seriously before?
deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was
Super
just
chat.
the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
Yeah.
You know, we're going
This may
to
go to
just
my-
say
go
we're
to my
going to
screen
react to
really
the
quick.
incoming data and appropriately, I think.
You just had
So
a super chat
I wouldn't wanna
indicating
put a number on what
what's
that
up
might
here.
be.
So this one's the
main thing
Dixie,
is to
the
get-
Dixie
to
here,
get
and this is
rates up.
Bitcoin, and it is moving.
And then pretty soon we'll be in an area
in
where
opposite, so-
we're
Yeah.
the beginning of the
as you
stream,
get closer to the
Dixie
end of
was
the
up
year,
here,
you're
and now
in
it's
a
come
range
down
where you've got
0.7%, and
restrictive policy,
the
which is
opposite for
appropriate.
Bitcoin has come up,
40-year highs in
let's
inflation.
say
We think that policy
4%.
need to be restrictive, and we don't know how restrictive.
Thank you for the
So,
super chat.
I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So. I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that
It's a vague question.
I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong.
That wasn't an
I
answer.
think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic. Where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that. And it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear. what you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really. And by the way, headline inflation is important for expectations. The public's expectations. Why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with.
All right, everybody. Am I live? All right, we're going to go ahead and end the live stream there, but we're going to quickly just kind of sum up what our thoughts are about everything going on. First of all, how about that? The first question was exactly what I wanted to see. They asked him, did he box himself in with those remarks? And he did a beautiful job of dancing around that question and not actually answering it. I think that might have been a theme of the entire press conference is when in doubt, say that we're reviewing the data. When in doubt, talk about the goal, the ultimate goal of getting inflation down to 2% and then keeping the job market in a good spot. A lot of dancing. So I'm a little curious, Tisham. I want to hear what you have to think. I'm curious to see what the price is doing. Of course, we had that little spike. Now we're coming back down. It does look like if you're on my chart real quick, Smay. I'm not saying it absolutely has to do this, but this has the markings of a little bull flag right here. If you guys are wondering what I'm talking about, we got a little symmetrical triangle building. Potentially, are we breaking out of there right now? I'm going to go ahead and say hold off just for a second, but somewhere right in this region with that little flagpole going. Again, there's still some stuff that has to happen. I want to see how other people respond. Some people are not sitting by their computers ready to invest on this, but as it stands right now, we're growing right now. I would say that we're going to see at least short-term bullish. It's really going to be interesting to see what the Bank of England says tomorrow because, again, just like last month, we had to wait for the Bank of England to actually see which way it was going to happen. We went bullish on that day, and then the next day when we found out the Bank of England was more hawkish, we ended up dipping. Tisham, what are your thoughts about that press conference as a whole? What are your big takeaways?
Yeah, absolutely. Well, you got two questions, essentially. You got 2 points on the Fed scale, but you had, and the first question was actually your question, Tim.
Yep.
So that's pretty cool. Also, I was only expecting unemployment to be a small theme, but as you could hear in the last 3 questions there, unemployment is becoming a much bigger question, and that makes sense because these are journalists asking the questions. A lot of times they're not maybe economists, right? So they're trying to reinterpret information for their readers who are people who are employed, right? And they want to know if their jobs are at stake or if they need to start getting with their family to make sure their family's employed or whatever. But unemployment was a lot bigger of a note in this than I thought it was going to be. We did mention it briefly on the morning show to be looking out for. But another thing that was interesting to me was Jerome was surprised. He used the word surprised by the inflation data being 8.6 versus 8.3. So that he said that they were expecting inflation to be flat or declining by this point. And I'm sitting there thinking, how could they think that? How biased is the data that they're getting? I don't know. So that one's kind of leaves me scratching my head a little bit. And then the other thing that stuck out to me was the difference between previous Fed. So if previous Fed, the tone would be, we are setting the pace for these rate hikes or declines, and we are going to continue those rate hikes or declines. But as you'll notice, Jerome Powell is much more pragmatic with his approach, saying we're going to change the rate hike or decline based on data that we're getting. So some might argue that that's a better approach, but what I'm pointing out, it's a different approach. In the past, they figure out, okay, 50 is going to be our basis point. We're going to do that until we get the job done, is what Jerome said. Versus now, Jerome is completely comfortable with going, 50, 75, 75, 25, 25. So it's like it's a different regime, and that I'll be interested to see how media outlets talk about that and how that's covered and how that ultimately affects markets. But looking at the price, it was interesting to watch kind of the markets move based on this. Nothing really crazy other than in that it's nice to see a correlation that makes sense when Bitcoin's going up and the DXY, the dollar, is going down. It's nice to see things that make sense. Also was pretty interested to see Tron doing really well, Uniswap doing really well. Tron actually up 6.2% right now, and then Cardano 6.27%. So doing really, really well. Obviously the big names, Bitcoin and Ethereum, still in the red, still negative there, but it's interesting to see some of the other. Uniswap up 11.6. So there's some names there that are getting bought on this data, which is really interesting. So.
Yeah, I think for me the big takeaways are, again, he just wanted to skirt everything with saying data wasn't. I mean, he talked about a couple of the data points they're looking at, but it did seem like his out of saying, well, we're just going to keep analyzing the data. Again, same as you, T-Shroom, when he said they were surprised by the inflation. We talked about it on our show yesterday about we knew inflation was coming, but I think the level is what surprised us. And of course, you hate to see it that the guy that is in charge of the Fed, he's the one being surprised by that. You would think that data he had would help him find out a little sooner. But as we talked about beforehand, I'd rather him do the right thing than just try to stick to his word. I'm super glad that was the first question. There's actually a couple questions asking about his take last month. I think what was really important also, and again, we have to see what happens here a month from now, but his statement when he said next month the debate will be between 50 and 75, he didn't say between 75 and 100. He said 50 and 75. There is a chance that we could see 50 basis points next month, especially depending on if they, what is he going to need? That I think someone should have asked that question. Do you need to see it 8.5, 8.3, 8.1, 7.9? What level of inflation do you need to see to bring us back down to a 50 basis point increase? That's still increasing the interest rate as a whole, but it's not as aggressive. He didn't answer that question. I don't think anyone asked that question. I would love to know more about that. But I think that's the big takeaway. That was a bullish statement that right the moment they're already talking about next month, they could be doing a 50 basis point thing, something to keep an eye on. As a whole, the market, again, it's moving sideways right now, but I think we're going to be moving a little bit bullish based off of this. And then that goes with that thing we talked about this morning. I truly believe 75 basis points was worked and baked into the market as a whole. Again, if we had 50, I expected that if we had 50 basis point announcement, we would have seen all the crypto, stock market, everything start to jump pretty aggressively. We didn't. We did see a little increase, but I think we got to watch this the rest of the day. I think that a lot of people are also going to wait for tomorrow. What is the Bank of England going to say? Because again, last month we didn't see significant move in the market until we had the Bank of England's announcement. That's going to be really important. So make sure, that's all we have for you guys in this video. Make sure you join again tomorrow morning for Coffee and Crypto Live. If you're new here, thank you so much for watching with us. We're going to keep talking about this because it's not over today. There's still some impact coming in the next couple of days. Stay tuned. Join us tomorrow morning, 10 a.m. Eastern Standard Time for Coffee and Crypto Live. Thank you so much, everybody. Again, on the way out, smash that like button, subscribe. And with that being said, I'll see you in the next video. Peace.
Oh, I got a real good